Markit now covers emerging markets for dividend forecasting. We've looked at the emerging markets index on MSCI, and we see growth of 2% this year, up to 225 billion, which is up 3.5 billion from last year. The index is dominated by the BRIC countries, and we see half of dividends coming from these four markets. In emerging markets, state-owned companies are very prevalent. As such, the state has a direct effect on corporate dividend policy, much more so than in developed markets. In developed markets, governments often make decisions which have an impact on dividends, for example on energy policy, but this is much more obvious in emerging markets. There are two main drivers which we see governments in emerging markets concentrating on dividends now, and these are: one, cash-strapped governments looking to increase their receipts, or two, they're looking to gain more transparency for international investors. Last week, the market flash PMI came in under 50 for the first time in 6 months in China. We think this slowing growth might actually have a good effect on dividends. When a company is fast growing, it doesn't tend to think about dividends, whereas when it becomes mature, it thinks about paying out more cash to shareholders. The Chinese government brought in guidelines that companies ought to pay out 30% of profits in dividends this year. However, we're seeing a third of companies which haven't met that level, which suggests there's further growth to come. Russia has also brought in guidelines this year. It's saying that companies must pay out 25% of profits. There's even been speculation that by 2016 this figure will be 35%, so we're also seeing potential upside there as well.